Good afternoon. So my name is Laurent Clerc. It's my great pleasure to moderate this panel, which will focus on green research and development. We will try to address the question of how critical is alternative energy financing. As you can see, I am here with distinguished speakers, and we will try to raise and address these questions. The starting point and the motivation of this panel is the observation that there is a funding gap and a relatively low level of expenses related to green R&D, whereas there are critical and very important financing needs in order both to accompany firms towards the energy transition, but perhaps more importantly, to develop alternative sources of energy. In particular, with respect to renewable energies, there are challenges related to both the issue of developing new sources of energy, but also developing a cheaper way to produce them, to distribute them, and also to store them. So this panel will be organized in 2 rounds. On the first round of discussions, we will try to present what are the ongoing trends or the ongoing development with respect to both innovation and the funding of innovation. And in the second round, we will try to address and assess the impediment and the solution that we can bring forward. Without further ado, I will start our panel discussion and first ask Charlie Donovan from Imperial College of London to provide us with his view about the key issues regarding the financing for long-term technological improvements and also the financing for near-term market deployment. So Charles, the floor is yours. It seems that Charles disappeared. So maybe we can then, waiting for Charles, asking Tim eventually if Tim, you can tell us about, from the IIF, Tim, whether you can tell us about the key trends that you are observing and the outlook in financial flows to green and R&D. So Tim, please.
Sure, Laurent, thank you for having me. It's such a pleasure to be part of the Green Swan event. It's been a remarkable program over the last couple of days. And let me just say, as we think about the trends in financing, the philosophy seems to be characterized by 2 schools of thought. We need really breakthrough moonshot technologies in order to get where we need to be. And by mid-century, the IEA says that only half of the emission reductions that we need will occur from technologies that are just currently in prototype form. There's an old school of thought that says, no, not at all. We have the technologies available to us now. We just need to scale and deploy and just keep investing at the margin and constant technological improvements. I actually think both schools are right, and we're seeing investment flows into both. In terms of the trends, which you've asked me to spend a few minutes on, 2020 obviously was a remarkable year globally. We saw a drop off in R&D spending in the private sector. Public sector held up a little bit better, depending on the region. The US, China, and Europe were much more stable than many of the emerging markets and other locations for obvious reasons. But what we are seeing, despite a dip in 2020 in the private sector, is a remarkable increase so far in 2021. Obviously, we're only 5 months into the year in terms of data, but we do see a pretty remarkable response. Let me just quickly go through public sector and private sector and venture capital, and then we'll go back to Charles, I think, who's back on. On the public sector, what we've seen is a really long, interesting cycle. We saw a tremendous amount of money put into renewables and R&D in the 1980s. And then the 1990s, we saw a plateau, and then we saw a really rapid increase in 2001 to 2012, also mirrored by the venture capital in private sector, which I'll get to in just a moment. And then since 2015, it's been a slow, steady slog. In terms of share of GDP, public investment in green technology is pretty stable versus what we've seen in healthcare or in defense, which has grown fivefold. So relative to other segments, it's been pretty stable. In terms of dollars, what we're seeing is about 25 billion per year globally. That's up from about 20 billion a year in mid last decade. The composition varies by region. In the U.S., we see more investment in fossil fuel replacement. In Europe and Asia, a lot of investment in hydrogen and fuel cells. And then in France and Europe, generally more focus on nuclear for all the obvious reasons. Lots of interesting new projects put in place over the last few years in the public sector. China's National Major Science and Technology Program, EU's Horizon Europe, Japan's Environmental Innovation Strategy, and the U.S., the crown jewels, the 17 national labs, including the National Renewable Energy Lab, which are really doing remarkable work, as well as the Advanced Research Projects Agency, ARPA, focused on energy. There's a DARPA, which is famous in the U.S. for seeding early stage technologies. There's a energy component to that. On the private sector, we've seen, private sector investment in R&D. There's a cyclical component. Obviously, when we've seen business cycles, we see a dip, as one might expect. In the private sector, we've seen investment reach 92 billion in 2019. And there's a lot of investment in renewable energy. We see a 74% growth in R&D, corporate R&D in terms of renewable energy. Auto companies are now a huge spender. A lot of them are chasing Tesla. We see numbers coming out of Ford and GM, as well as other new startups in an effort to electrify their fleet, which many of them have set 2030, 2035 to go to 100% electrification. So tremendous amount of auto company or green R&D. What's interesting, though, is that energy companies spend only a small share of their R&D revenues in green technologies, only 10 to 30%. So there's a real upside potential for energy companies. And I think you'll see that, especially given what we saw with ExxonMobil in the past week. Venture capital is interesting. We do see an increase in venture capital funding, but we've seen two really interesting cycles. One is in the what I'll call a green tech 1.0, which was 2006 to 2011. There's a real surge, about 25 billion invested in green technology. Unfortunately, about half of those investments went bankrupt. A lot of that was in solar, and what drove many of the investment solar out of business is the Chinese got in the solar business, did it in a large way, drove down solar prices by 80%. So it really changed the dynamic for many of those investments. Then we saw a real pause in terms of venture capital funding until about 2015, 2016. And that was really led by the Gates Ventures, Bill Gates and his breakthrough technologies and Gates Ventures. And what we've seen since then is a change in philosophy, more thinking about investment in green technology, more like pharmaceuticals, long patient capital, rather than quick moonshots, trying to get 100x in terms of returns, much more disciplined. In 2020, we saw 503 VC deals in clean energy versus 93 in 2010, so a five-fold increase over the last decade. And SPACs are playing a huge role as well. We had 40 SPAC clean technology investments over the past year, and we've seen share prices in clean technology firms up 137% this year versus the NASDAQ up only 48%. In terms of funding, all energy venture capital funding is about 16 billion, but only 4 billion of that is really into early stage venture capital, seed and A and B rounds. In terms of broader private flows, there are 4,500 ESG funds globally, but only 18 of those are funds labeled as green research oriented funds. And that's about 7 billion in net flows, about half between equity funds and bond funds. So in sum, we're seeing about 120 to about 125 billion per year in terms of flows into green R&D. The problem is, according to the IEA, is we need 350 billion a year. And so that's a funding gap of around 225 billion. I round off a bit, a funding gap of 225 billion. So if we're going to get to 350 billion from the current 120 to 125, we need a whole host of changes, which I know we're going to talk about in part two. So with that, I'll turn it over back to you, Laurent.
Yes, thanks a lot, Tim, for providing us with these trends on financial markets and venture capital. So, Charlie, we are back to you. So, would you mind? Yes.
You have to forgive me for whatever happened there. Do you want to just tell me, Laurent, where I dropped out, because I wouldn't have seen it on my screen until.
Yes, we barely have the chance of hearing you, so just as if you said nothing, so you can start from scratch.
Okay. Great. Well, I'll try to come back in it, and apologies for that, and thanks for accommodating. So what the remarks that I wanted to lay, and as I heard what Tim described, is really the important context for incredible changes that are happening in the capital markets today. But if we look particularly at emerging markets, where a lot of this investment has to occur going forward, we still have far too many examples of old, inefficient, and polluting technologies that dominate those systems. And so the question becomes, why is that happening? Why is that happening? Because we should have great optimism at this moment. So for all the reasons that Tim just described, but there are many more. So solar, wind, battery storage are cheaper today than even the most bullish forecaster would have predicted 10 years ago. And for most markets in the world, they're the cheapest way to create power. We see every global bank now backpedaling from coal-fired power and raising the cost of capital for using the world's dirtiest fuel. And we've observed a number of trends, and Tim touched upon some of them, but that say that not just over the past year or the past quarter, but over the past decade, renewable power has outperformed in both a risk-adjusted basis and an absolute basis fossil fuel stocks in stock markets around the world. So if you take all of that, then you ask, why are we still not moving the needle? Why are hundreds of billions of dollars of capital expenditures still being made by corporations around the world that really have no future in a post-carbon economy? And I would like to suggest three issues here that are really holding back on the demand side, because technology is not the bottleneck. And what we really need to deal with are features of the global financial system that are actively reinforcing the status quo and actively working against this transformation. And so there are three issues I'd like to offer. The first is electrification. So we're moving from a hydrocarbon-based economy to an electric economy. And that entails huge changes, because our economy is built today as an export-based global economy with US dollar-denominated commodities based on oil, coal, and natural gas that can be transported and sold all around the world. And so if you're going to drill deep water in Angola, you're going to find yourself in a less risky position, ironically, than putting solar panels on land in Angola. And that's because the solar panels are going to generate cheap electricity, but it has to be sold in a local currency and it won't go long distances. So this shift from hydrocarbons to electricity is fundamental, and we still have a number of financial regulations and investor incentives that are reinforcing the status quo rather than moving us to a new place. The second issue I'd like to introduce is capitalization. So a decarbonizing economy, one that we all hope every country around the world will be doing over time, is also capitalizing at a faster rate. And that's because for a country to get out from under the economic capture of fossil fuel imports, it has to pay up front for these savings over time. And so a transition to a post-carbon economy will require much higher levels of investment spending now. And that's particularly true in emerging markets. And as of today, international financial institutions are not building the bridge that would allow these countries to access international capital markets. The third issue is decentralization. And here we see that technology is delivering an energy system that is cheaper, safer, and cleaner than the one that we have today. But it's also more distributed. And so that means more complexity, it means smaller deal sizes, it means less centralized control. And that is just an anathema to state-owned enterprises who still dominate the energy sector today. And so if you look at just one country like India, Coal India is owned by the state. It's the world's largest coal producer, and it employs about 300,000 people. Take, on the other hand, the renewable power sector, which has no state heavyweights and has to produce returns which are acceptable to shareholders. And so while we probably don't want to enter into debate on this panel about states versus markets, I'm certain that a transition could occur using both. We do need to be clear about how the playing field as of today is currently tilted. And so time to move on, but let me just offer these 3 issues, which are really demand side issues. And I don't think anybody on this panel is going to come and say that the biggest problem that we have today is the supply of money. But on the demand side, these issues of electrification, capitalization, and decentralization are really holding back new energy financing at a truly global scale. And I think these are the solutions that we need to find in order to find a transformation that would lead us to a safer and more prosperous energy economy. And with that, I'll leave it back to you, Laurent.
Okay, thank you, Charlie. So I think we may come back later on in our discussion to this issue of public versus private financing, to the extent that so far, if we look at technological changes, and in particular research and development, the role of the public sector has been always huge. And as you're referring to, in a way, we are moving from an oil-based economy to some extent, or coal-based economy, at least fossil fuel-based economy, towards, as you rightly put it, electrification. So this is also a major shift, and which is something that we have seen over the past, and perhaps a new transition. So now we will move to 2 concrete examples relying on 2 private sector, should I say, experience. So I will start with Thierry Fornas. So Thierry, you are President and Chief Executive Officer of EcoAct, and you will talk about the voluntary carbon markets. So Thierry, the floor is yours. Oh, we don't hear you, Thierry.
Is that okay? Thank
you
very much, Laurent. So to answer that question, we first have to understand why do we need to scale up the voluntary carbon market. So first, we have to understand that a robust voluntary carbon market is an important tool that private sector can use to tackle climate change and achieve net zero emission by 2050. Indeed, offset can contribute to the net 23 gigaton of CO2 reduction, which is required to remain below the 1.5 degrees through financing reduction, avoidance, and sequestration measure. And to reach the net 23 gigaton CO2 reduction by 2030, which is a target, 2 gigaton will likely need to come from sequestration and removal. And achieving 2 gigaton by 2030 requires a 15-fold scale-up of voluntary offsetting in 2030 versus 2019. Second, voluntary carbon markets have made significant strides in terms of carbon and of credit integrity, transparency, and market efficiency since its early days. And there, EcoAct has been among pioneers working on the voluntary carbon market for about 2 decades now to develop and finance climate compensation project, promoting the best practices in that sector. Today, we are facing, since 2020, we are facing 2 main questions. One question on the supply side, how to intensify the flow of investment in green and offsetting projects with sustainable development goals, saying social co-benefits in developing countries, in nature-based solution projects. And a question on the demand side, how to respond to many companies, especially in hard-to-reduce sector, which will have to offset emission when they reach their decarbonization sector. I'm speaking about hard-to-reduce sector like aviation, but also steel, cements, and other manufacturing sectors. So as a result, the current key challenge is how we can scale this voluntary carbon market and what condition do we need to meet. So I would say that the answer to the question of the scaling up of this voluntary carbon market is threefold. First condition, providing right incentives and guarantees on the supply side. First, we must consider net zero policy ambition, even if we are talking about voluntary climate action. All high-level policy signals and regulations in favor of net zero emission are welcome to support and incentive private sector engagement. For instance, we are facing COP26 mobilization, Leaders Climate Summit, COVID-19 recovery package, a commitment of the US, China, Japan, Europe to achieve carbon neutrality by 2050. Second, we need to enhance environmental integrity of offsetting reduction and avoidance projects. Low carbon projects become profitable and viable when emission reduction, avoidance, and sequestrations are verified and thus get an economic value. In line with the ambition of scaling the market, a supply of highest quality carbon credits will need to scale rapidly without sacrificing integrity. And to do so, we'll need to define a standard set of exclusion rules, guardrails for methodologies to guarantee that credits trade in voluntary carbon markets uphold environmental integrity standards. And last, we have to develop robust framework and new innovative methodologies for sequestration and removal projects for nature-based solutions and technologies. For negative emission technologies such as DAX, BECS, and other maturing climate technologies like green hydrogen, we need to develop new methodology in a timely and robust manner. The second condition that we have to fulfill, legitimated and strengthening the demand from corporates. First, establishing principle on the use of offset can help ensure that offsetting does not in any way disincentivize companies' internal climate change mitigation efforts to reduce Scope 1, 2, and 3 emissions, which is a priority. Second, aligning recommendation on how to communicate the use of voluntary offsetting in corporate claim is key. It's essential that corporate reports annual emissions, articulate clear trajectories towards the climate targets, and include plan for offsetting while respecting communication best practices. There are ongoing initiatives with ISO in which EcoAct is involved with the science-based target, SBTi, to define the role of offsetting in supporting net zero claim as well as efforts done by investors via climate-friendly organizations. ISO also will issue standards in March 2023, and SBTi will disclose their net zero principle at COP26. Last, beyond voluntary markets, compliance market will likely grow over time as regulatory requirements, national and sectorial, increase and could include offsetting projects. In addition, sectorial agreements such as CORSIA could also be structured, including a share of offsetting credit. Last but not least, the third condition, structuring the trading market to increase its efficiency, liquidity, and transparency. In terms of market efficiency and liquidity, we have currently a very fragmented market, and we need to standardize contract to order to increase the transparency and the liquidity. And regarding trading infrastructure, a core set of infrastructure components could be put in place to build a market work that can trade larger scale volumes. That's all for me. The floor is yours, Laurent.
Okay, thank you very much, Thierry. So you too raised some issues with respect to heterogeneity, fragmentation. So we might come back to that in the second round of our discussion. Suren Erkman, you hold a double hat in a way, as an academic on the one side and as a practitioner on the other. In this panel, you wanted to address a specific aspect which so far has perhaps been overlooked, which is the carbon capture and utilization market. So maybe you can expand a bit on that and elaborate a bit on this issue. So the floor is yours.
Sure. Thank you very much, Laurent, for the invitation. Yes, actually, just in the extension of what Thierry said, I would like to focus on a specific aspect of the so-called negative emissions, in other words, absorptions, which is known as a CCU. But CCU itself is a very vast family of different technologies and approaches. Now, I would like to focus on that for two main reasons. First of all, when we talk about carbon capture and then utilization, we are really talking about physical, real CO2, which is extracted from concentrated sources, industrial processes, or directly from the atmosphere. So it's not about a potential, theoretical, or even imaginary avoided emissions. It's really in a controlled manner using CO2 in the economy, which is not that easy also with nature-based solutions, where it's much more difficult to know exactly what is happening, for example, in soils or in forests or in natural ecosystem. Here I'm really referring to using CO2 or carbon in the economy in terms of product. So I think there is an advantage there that we can really verify, and we know exactly what we are doing, at least in a very high extent. The second reason is that, as far as I know, CCU, so utilization of CO2, is the only strategy which allow to generate directly revenues from carbon or CO2. Of course, the value of CO2 can vary from different pathways, but it can be pretty high. The value of CO2 as a product or at the basis of a product can be really high. And I think it should be, or it should be perceived as really a game changer. Now, for this tourism, I think CCU should deserve a special status among many negative emissions strategies because it immediately contributes to stabilizing or even decreasing the concentration of CO2 in the atmosphere. So I think in the various financial scheme, there should be a special reward for this kind of utilization of CO2 within the economic system, where we know it really contributes to decreasing the concentration of CO2 in the air and generates measurable economic benefits. But I'm stricken that for many, many years, it has remained a totally underfunded area. So there is clearly still a strong funding gap for CCU, in my view. And more specifically regarding finance, I've been discussing for many years with experts in the financial area, and still I cannot grasp exactly for what reason it doesn't seem really to appeal to them. Maybe it's not easy to make understand why exactly it is different than other offset strategies. Well, maybe one reason is the technical aspect of CCU. It can become quite technical, it's not trivial, and you have a huge arrays of technical solutions. Maybe that's another reason. Another reason is maybe carbon capture and use, especially use, does not fit in the traditional investment universe, which is familiar to investors. But I suspect one key reason may be that there is a need for a kind of cognitive jump to stop looking at CO2 as something bad which should be eliminated, which in a sense should be, of course, but it can also be seen as a resource, as a valuable resource. And it seems that it's not easy to make this a cognitive jump. So, of course, we have CCS, sequestration, but here I want to focus on CCU, knowing that both are complementary to a certain extent. But again, CCS is likely to remain quite costly, even if the potential is huge in terms of quantities. Now, so far, in terms of quantities, CCU is much less for the time being, but this may change even rapidly, provided the good framework and the proper funding is provided. But especially, again, regarding finance, I think there should be a specific reward regarding investment in CCU. By that, I mean using carbon within the economic system. I will stop here for now. Thank you.
So thanks a lot, Suren. So we will now complete our first round of discussion and overview, so to speak, of the trends and the issues with Professor Jan Goldin from Oxford. So Professor Jan Goldin, you will tell us about perhaps the new frame emerging to facilitate green R&D, and perhaps what we can expect also on the task force on scaling voluntary carbon markets. So Jan, the floor is yours. Oh, we don't hear you, Jan. You are muted. We can't hear you. Do you have do you have a mic or an helmet? No, we can't hear you. Maybe yes, let's
Can you hear me?
Yes.
Okay.
Great.
Let's use that. So apologies for that. Vital to have new ideas for green R&D. And of course, the scaling of voluntary is also absolutely vital. What we are seeing in the current phase of R&D for the energy transition is, if you do the economic analysis, much less than has been with previous revolutions. And that's partly because the biggest developments in energy have been on solar and wind, which has been largely the result of private investment and private R&D, which has not required the scalings that have come from previous big energy revolutions, as was the case, for example, that DARPA was associated with in the US historically and elsewhere. But to get to the next phase, Suren has mentioned carbon capture, but there's equally grid and storage, and hopefully we move into a fusion world of storage. We are going to need a totally different orders of dimension of R&D, which will have to be public-private partnerships. And that means that we need a renewed effort. One of the negative impacts of the pandemic has been a concentration of R&D in pharmaceuticals and a decline in other areas. And incidentally, also a concentration of expertise, of scientific expertise in university departments and elsewhere. So this is vital that we have this step up in government. I believe it should be a multilateral effort. It should be something which is discussed in the context of COP26, because technology somewhere should be technology everywhere. And this we get into the discussion of intellectual property rights and how this would be done. Should we have a prize, a global prize? Who would fund that? Or should this be private and private stopping distribution? But there are some breakthrough technologies, particularly on battery, on modular power, nuclear and other, on grid and storage. In terms of the scaling up of voluntary carbon markets, there's an immense amount that's being done, and I encourage you all to look at the website of the Scaling Voluntary Carbon Markets to get a sense of the depth. And Tim, I know that you are one of the drivers of this process, and I want to congratulate you and your colleagues for how much has been done. And as you'll see on the website, there's a consultation process on at the moment that I would encourage everyone to participate in. Some of the big questions that I think still need to be addressed are the sense of scale of this in terms of its reach, particularly to developing countries and particularly to China and India and Brazil, where there is a massive need for this. A second big question is in relation to the carbon price and what carbon prices in different jurisdictions. And this also relates to a third question, which is carbon border prices, and whether we should implement, which I believe we should, carbon border adjustments to encourage behavior and to stop offshoring of dirty carbon, which many jurisdictions, including, I would say, the UK, is doing. The regulatory environment is important. A fourth key question is in relation to what a regulatory environment, a voluntary carbon market, and a citizen action does. And I think what we've seen in Chevron, in ExxonMobil, and in Shell in recent weeks points very graphically to how these things can work together. But clearly, things have moved at a pace in ExxonMobil that they wouldn't have, I think, through purely voluntary market. And that points to the need for citizens and NGOs and others to be involved. And the final big question in my mind is in relationship to development, particularly post-COVID, sharp contraction in fiscal space, a sharp increase in energy demand from minerals that are extractive, which will require very, very strong energy intensity, not least including with the electric vehicles and batteries. And of course, also the implications of geopolitics in this. A Cold War between the US and China will do more to derail this than anything else, not only because it won't bring China into a voluntary carbon market, but also because, for example, it will lead to stronger demand for soya from Brazil, which will lead to a more rapid destruction of the Amazon. So these unintended second-order consequences really matter when thinking about the implications for the overall carbon emissions. And in that hope, I want to applaud this initiative as being wonderful in its breadth and depth, and the people that are involved in it, Tim, you and others. But it's not a panacea, and it's part of a much bigger picture which needs energetic engagement from all actors, not least governments internationally.
Okay, thank you, Jan. So we just finished the first round of discussion, and we have seen that there are quite a lot of things ongoing, lots of financing in the pipelines, lots of opportunities as well, but still there is these funding gaps. So some of you alluded to the possible impediments. So there is this issue of public investment. There is this issue of also voluntary versus eventually mandatory carbon market. So some of you touch upon also the issue of pricing. And regulation. So as a possible impediment. There is also this issue which is not completely clear to me of supply versus demand. It seems to me that there are also kind of supply related issues in the extent to which there might be, and it's related to a point made by Suren, about some form of, I don't know, confidence perhaps in the technologies which are there yet and which have not convinced, for instance, the investors at this stage. So these are the kind of impediments that we, in a way, you have highlighted in this first round of discussion. So maybe in this second round now, what we would like to do is perhaps to go a step further and to look at the extent to which there are at least solutions or ways in order to address that, and perhaps also to take one point that that Jan made with the involvement of the population in a way, and you were referring to some litigation aspects related to oil companies. Most of us have in mind in this transition and looking at the funding and the role of financial markets, a kind of orderly transition. And what you were pointing out is also that there is a risk of disorderly transition, or at least something which might be more sudden than expected. So that might also increase the risk for the financial sector. So these are the kind of things that we can perhaps touch upon. So we will now start the second round. So perhaps starting with Charlie. So you referred also to the challenges made in emerging markets, and so far, looking at perhaps the issue of funding with emerging market, there always have been this issue of developing domestic markets, strong domestic markets. So here, one aspect that has been touched upon, and you will perhaps say some word about that, is the limitation or the extent to which green bond market can facilitate the transition. And I know that you have also some, at least, you would like to raise or at least have some challenges with respect to the voluntary carbon market. So Charlie, if you can elaborate a bit on these two aspects. Thank you.
Thank you. Thank you. It'd be my pleasure. So maybe on the first question about bond markets and their usefulness. I mean, we've clearly seen a huge wave of interest, a lot of growth in primary issuance. These are all positive trends. But for emerging markets in particular, and I have to say that there's a bit of a proof in the point here, because the reason I'm in East Africa at the moment and I drop out on the I have to have 3 Wi-Fi boxes in order to make sure that I can maintain a connection with you. But the idea that we would take all of the structural issues that exist in emerging markets and then put a green label on top and that would magically fix it is fantasy. And so, you know, we released a discussion paper a couple months back. It's available on the website for the Center for Climate Finance and Investment in Imperial, but really saying that, you know, the ESG as an issue is already within the domain of a lot of asset managers, and clearly they pay attention to it, but they pay attention to G, and because they are clear that G is a financial risk factor for them. What they don't pay attention to at the moment is E. And there's certainly a almost an unwillingness to step into a discussion that would involve, what does this really mean? And we have, through other research and others that have increasingly done this, identified that there is a real risk of a flight of capital from emerging markets because they are, by and large, the ones that are most vulnerable to climate change. And it's both in its physical manifestations, but also in its transition risk, where you have really high fossil fuel exports from some countries. So this is a real critical issue, and I know there are other panels that have been exploring that in the conference, so I don't want to spend too much time on it. You asked a second question, though, which is really about the issue of what role in the supply-demand balance, what role can voluntary markets have? And I really agree with the point that was made previously. The Tim's organization and the folks that have been working on this task force have laid out in a lot of detail in their consultation document what are the issues and how should people be thinking about this, and seem to still have an open mind about how this can turn out. The one cautionary tale I would like to add, and this comes from 25 years ago, I was working for the U.S. Environmental Protection Agency designing voluntary markets in the run-up to Kyoto, and there are two big issues that come up there. It's very complex, but you can boil it down to two issues. It's about baselines and it's about boundaries. And the issue about boundaries is almost impossible to solve, because what happens, as was illuminated earlier, I can never be sure that when I undertake some project-based activity here, that simply doesn't move to over there. And what over there is, there's 1,000 different manifestations, but we have to be really careful. And while there are maybe some pure examples like direct air capture for CO2, it's very hard to establish boundaries at a subnational scale. The second issue there is about baselines. So it's about what do we need to be doing anyway? And here the analogy that I tend to use is around a bathtub. We've got the atmosphere as the bathtub, we've got a tap going in, which is emissions, and we've got a tap going out, which is removals, and clearly the bathtub's getting fuller. And we got two choices. We either shut the tap at the top or we open the tap bigger at the bottom. Now, the issue is that these genuinely have to, even if they're avoided emissions, they genuinely have to be removals, because we're no longer in the position where just, reducing against some growth metric is good enough. Those were the sort of choices that we had maybe 30 years ago when the trajectory didn't need to be as steep as it does now. But now where we are, it's very hard to see any activities besides some of these pure examples of technological removal that aren't constituted of the stuff that we got to be doing anyway, that this is all baked into the idea about how we get from point A to point B. And so, where the rubber hits the road for me is that, voluntary markets in stimulating and encouraging innovation, in getting new players on board, those are all still very valuable attributes. But we have to be extremely careful about linking voluntary markets to compliance markets, because that's where the accounting breaks down, and that's where we get into trouble in terms of thinking that we've got an asset that we don't. And my greatest fear is that, working with a lot of companies who are on this journey, is that they end up thinking they've solved the problem, only 5 years later to come and find that the accounting at the planetary level didn't work, and they've got to do it all again. And that's clearly a situation we've got to avoid.
Okay, thank you, Charlie. I will move now to Jan. So if you want to react also to what Charlie just said, please do not hesitate. And since you introduced the role of public funding, I would like to hear you also about the initiatives which are all over the place with respect to Green Deal, and what can we expect from that, and is it a game changer or not?
Thanks very much, Laurent. I hope you can hear me now.
Yes, well.
And I very much agree with what Charlie and other speakers have been saying. Green New Deals have to be a game changer, but whether they are or not, the jury is still out, would be my view. They are just being announced. We're yet to see the detail on many of them. The one I think that is most advanced is the South Korean. And that's attractive in many respects, including that it's linked to employment and the transition to a more digital economy. Of course, where digital power comes from is an absolutely crucial question, and ensuring that our cyber system doesn't become the big new carbon emitter is central to that. The European deal and the US deal there's huge amount that still needs to be worked through, and there's a huge amount of federalism in the European deal, which could lead to very different implementation in different countries of Europe. The lesson we need to take from the global financial crisis is that stimulus packages can be disastrous for the environment, and that what we saw following the global financial crisis was a short-term decline in emissions and a very steep increase following the crisis, because basically cement and steel and infrastructure are very high carbon intensity. So this is the time to think very deeply about what we mean, and how is the Biden green stimulus package going to work with an infrastructure package that is not at all green. And the design and detail really matters. And of course, we have this vexed problem, particularly with cement and steel, that we need urgently to solve. Again, it comes back to the R&D question. My biggest concern in this respect is with respect to developing countries, as Charlie has mentioned as well. The fiscal space is closed for many emerging markets. And that is going to lead to a much slower energy transition unless the rich countries come up with 100 billion. Well, they haven't come up with 100 billion in response to COVID. They haven't come up with a proper distribution of the vaccine. That doesn't bode well for a distribution of clean energy and 100 billion for clean energy. So this is the big stimulus deal that needs to happen in China, in India particularly, where fiscal space is rapidly collapsing. So I am very concerned about that. The second point, and this relates to the voluntary carbon markets, I would stress, is the need for predictability and offset. I've been involved in trying to construct deals which would allow rapid transition to clean energy in countries like South Africa, India, and Brazil, and a commitment to close down coal power and replace them with new power. The question is, where's the money going to come from to pay for the just transition of workers? So you're not going to do this unless you provide the people you're laying off in coal mines, in power stations, others with jobs. It's different places with different skills and different people that will benefit from the green transition. You cannot expect governments to go through this transition without worrying about that issue. And of course, there's a big issue about the predictability of the finance. We can barely raise the money for 1 year, let alone 20 or 30 years, which is what you require for an energy transition. And that goes back to the point which I think Charlie was alluding to, is about how you create a long-term, deep offset capabilities, which will allow you to commit, say, India or South Africa or Brazil, 20-year financial streams of cash if they close down their carbon power or other industries. And that is yet to come, whether it's from the airlines, whether it's from voluntary carbon markets and others. And I would say if that problem can be solved, we would have made a massive, massive inroad in financing. Finally, there's a whole group of other actors like the IFIs, the CDCs, the Proparcos that can get engaged through blended finance, through debt equity swaps, subordinated debt, and in other ways. And that coordination needs to happen much more urgently than has. We need to find the 100 billion that was promised in Paris, and we need to find it this year.
Okay, so there is a challenge that appears hearing Charlie and Jan, which is that of the urgency with respect to the need for long-term funding with respect to research and development, which is usually something that is not immediate. So there is still this challenge, I think, that you are raising. I will move to Tim because during this panel, there were a lot of emphasis and also of acknowledgement of the work that you are doing in developing voluntary carbon markets. There were some also not reservation, but at least aspects that were challenges that were put forward. So I don't know whether, Tim, you want to elaborate on that, and then also to look at perhaps the impediment. What is currently explaining this funding gap that you already size and which is big, and what role can precisely the public sector do? Is it in terms of funding? Is it in terms of regulation? How can it help this development in the current juncture. So Tim, please.
Sure, Laurent. Thank you. Let me first of all say thank you for all the wonderful words about our TSBCM. It's we've been at this since September. We hope to get this thing wrapped up by July, and we'd love to see contracts being traded by early autumn. Look, there's a lot of work to do, and there's 30 years of legacy that we have to overcome. Charlie hit it nail on the head. You need to deal with baselines. You've got to deal with leakage. You've got to deal with additionality. We've got to have high quality credits. We've got to be well defined. There has to be a trading infrastructure. Tremendous amount of work has to be done. We think there's a huge market out there, and we're determined to see it come through. And we can't do it by ourselves. We appreciate many of you who are on this call who've been active participants in seeing this thing come to fruition. So we're excited about it. It's one of, all the above that we need to undertake. You asked about the public sector. Absolutely, public sector needs to play a role in terms of actual funding. We see some strong signals out of the Biden administration. Now, how much of that actually gets passed by Congress remains to be seen. But the top line message is pretty powerful, and it really a game changer from what we've seen over the past 4 years. The issue is the sustainability of that. Investors want long-term policy signals. If you're going to sink your money into some long-term investment, you want to know that the demand is going to be there, that the policy regime is there, and the game isn't going to change on you halfway through. So there is the signaling impact, there's the financing impact, there's providing tax incentives, there's the scaling. If you think about sustainable aviation fuel, there's no reason why the Department of Defense, maybe in conjunction with NATO, could say, look, we're going to buy sustainable aviation fuel. Just the sheer volume of demand could shrink that green premium, which is now probably 3x over standard aviation fuel. So there's a huge role they can play on the emerging markets as well. Not only the industrialized world, but using the IFIs. And I think Charlie's spot on. There's so much that has to be done in the developing world. I was meeting yesterday with someone from the Asia Development Bank. Most of the energy produced in their region, including many emerging markets, is coal-based. So how do we provide the financing to help those countries transition to a different energy source? And you can't do it without the IFIs. You can't do it without the public sector. It needs to be both direct funding and it needs to be guarantees. Private capital is a coward. And to lure private capital into those markets, you've got to find, first loss tranches. You've got to find ways to mitigate the risk. And there are the instrumentalities out there, whether it's MEGA or regional variations. You also have to look at the issues of the labs, which I mentioned, in terms of how do we more quickly commercialize what's been done in the laboratory. And I think there's a real incentive to deployment of leading edge technologies. And lastly, with just a minute left, moving from a carbon-based energy source to a minerals-based energy source is a remarkable change in the way in which we'll run our global economy. And I say that because an electrified vehicle requires 6 times the amount of minerals that an internal combustion engine vehicle requires. If we're going to electrify our global fleet, we need to increase mineral extraction by 4-fold over the next 40 years. Many of the mineral sources don't yet exist, and many of them are in places like the DRC or in Philippines or in Indonesia or Chile, in which many of the ore quality of things like copper is already being fairly depleted. So we're going to have to dig up a large portion of the world, including in many emerging markets, to find the cobalt, the lithium, the nickel, the manganese, and a whole host of rare earth metals that I can't pronounce the names of, in order to provide the inputs to an electrified fleet, to solar panels, and in terms of wind power. It's a really remarkable change. And we really need capital in those areas to think about where those minerals are going to come from, the political economy of that, the processing, most of which occurs in China, and the environmental and energy needs to extract, process, and then deliver. And so I think that's a place where we're going to need public sector direction over the next several decades, because we can't simply go from carbon-based to non-carbon-based without thinking about what is the supply chain that is required to have a different configuration.
Okay, so thanks a lot, Tim. Maybe we can now turn to Thierry with more specific, perhaps, views on the impediment. Thierry, I think your liaison is unstable, but Yes, can you perhaps told us about the impediment on the carbon market? Yes, but
okay.
you're
right. Yes,
yes, we hear you well. Yes.
Okay, so thank you for that question, Laurent. So I fully agree with what Charlie said at the beginning regarding the issue of the baseline and the boundaries regarding the voluntary carbon market. And what I raised as the first condition for scaling up this voluntary carbon market are the guarantees from the supply side. So it's very important to have environmental integrity, high quality carbon credits, and that we've got to reinforce the methodologies and have a robust framework, having exclusion rules, guardrails. That's what we've been working on with the standard for more than 2 decades. That's what I said at the beginning, to reinforce this market and to be sure that when our customers are doing offset, they can be sure that they've got a strong impact on the environment and on the climate. That's a key topics that we've got to address. But what we are facing also is a key problem regarding the lack of shared vision for and understanding of the role of offsetting in supporting the achievement of a net zero goal. So we face a lot of ignorancy, lack of knowledge regarding this topic. Direct emission reduction by corporate must be the priority, and we are sure about that, but an appropriate offsetting can play an important complementary role to accelerate climate mitigation action. And this is key, and that we are fighting every day to be understood from our customer. And it's fundamental that offsetting is done through what I said, high integrity carbon avoidance and carbon dioxide removal project, such as their compensation leads to genuine carbon emission reduction and environmental benefits. And that's a mission we've got from the beginning of EcoAct, and it's a day-to-day fight. So I'm very happy about the emergence of this task force on scaling voluntary carbon markets, because we are building a market, a sector-led initiative launched last year to scale the voluntary carbon market. I will not speak about it. A lot of people, team spoke it about this topic. I would focus on some of the recommendations that has been raised, like governance, which is key, identify key governance gaps in the voluntary carbon markets, and recommend how they can be filled by either new or existing governance body. We've got lots of governance body existing, the standard, we have gold standard, we've got Vera. We don't need to reinvent the wheel, but we just have to think about right governance to make it even stronger. Second, legal principle and contract, develop standard contract mechanics and corresponding contract templates to enable trade of carbon credits. We spend so many days, months, and years to have the right tools and contracts to reassure our customers that it's key that we all agree on the right level of contracts that we will spread on the market. And credit level integrity, mature the core carbon principle threshold standard in order to increase the quality of carbon credit. This is key. So we are expecting eagerly the recommendations that will be published in July 2021, while providing many more environmental, social, and economic benefits, let's call the Sustainable Development Goals. And what you said already, I think that Jan who told that, last but not least, we've got very strong new positive signal coming from the US with Biden, who announced the US will rejoin Paris Climate Pact, and now all hopes are allowed.
So that's a positive aspect. So Thierry, you just alluded to the role of removing carbon emissions, and that's precisely a topic that was also mentioned by Suren. So Suren, what would be your views in terms of how can research and development can foster negative emissions?
Yeah, thank you very much. In 1995, during my first mission as a consultant for the UNFCCC, I was sent actually in Armenia to start the whole process of implementing the climate convention. when I was confronted with the administrative complexity of the whole UNFCCC rules and similar rules, that's when I started to realize that in any case, we are going to need, as it was recalled rightly by Charlie in the beginning, we are going to need at a massive scale what is today called negative emissions. And I fully agree. That's why I'm really interested in this topic, because whatever we do, we are going to need it, and at large scale. Now, regarding funding in relation to negative emission, I would start first with a general comment. I think in terms of fund allocation, it's not huge funds compared to other things, but nevertheless, there is a high priority to keep funding high-level, good, fundamental scientific research on the various aspects of climate change, be it physics, chemical processes, feedback mechanism, modeling. This is far from over. There are still many uncertainties. There are still many points which are not clear. So we still need a lot of good fundamental scientific research on climate change, all the basic processes. I just give you an example. Recently, there have been a number of companies claiming carbon credits when they inject CO2 in the underground, and they claim that this CO2 is being mineralized, I think you would say, so that you are really long-term sequestrating carbon in minerals, because CO2 reacts with minerals a few hundred meters deep, and then it's supposed to become a mineral. Now, if you look at it from a biogeochemical point of view, it's far from proven. And we need typically there a good of fundamental high-level research, because there are very good reasons to think that, in fact, the CO2 is not really mineralized. It is absorbed by a huge amount of biomass, bacteria which are living there deep in the ground. And the biomass is just growing, then it will decompose, then it will generate CO2 again, or methane. So this is where there is a link clearly between improving our knowledge about the fundamental aspect linked to climate change and carbon metabolism and these things, and of course, high quality offsets and negative emissions. So that was a kind of general comment. Now, regarding CCU, of course, the priority of funding should also go for investigating the various pathways, because you have large families of pathways, like shall we use CO2 for building materials, or for synthetic fuels, and for polymers, and for food, because that's one of the options. You can do microbial proteins based on CO2. So this is where a lot of research need to be funded, is to investigate and develop the fundamental R&D on that. Think, for example, of improving the electrochemical reduction of CO2. This is a very important field, which of course need to investigate it further, and that should be a priority for funding, which is really the technical aspect of consolidated the various and exploring the various technical pathway to not only extract, but of course transform or use the CO2. But beyond these purely technical aspects, of course, another work which very recently only started seriously is to carefully assess the environmental performance of the various pathway, if you want to really transform CO2 and make it useful in the economy. But what are the respective environmental performance, and also, of course, their associated economic benefits? And it's a very challenging exercise, because you need to work at a system-wide level with complex interaction between the different value chains. So there are a number of relevant docs on the website of the new association called CO2 Value Europe. So if you want to know more, you can check the website of this association. We also need, at the larger level, at the economic-wide level, what we are talking about, in my view, is that we have the geological carbon cycle. Inside it, we have the biospheric carbon cycle. Then what we would like to achieve is an anthropogenic carbon cycle, where we use carbon in the economy instead of dumping it in the atmosphere. But really modeling, understanding at the level of the global economy, what a real anthropogenic carbon cycle with flows and stocks. I think Charlie gave the example of the bus tube. It's a very good example. But if you want to give more precise about dynamic understanding of the flows and stock, where it should be in the economy, what is the lifetime of the various products, where the stock will turn into a flow and then again will be, and so this kind of thing. So there is quite a bit of research to be done economy-wide to understanding what we would call today a circular economy applied to carbon. And finally, where there's a lot of research, which is in that case not technical to be done and funded, and where there is clearly an impediment, is to elaborate a coherent and relevant in what I would call institutional framework to help large-scale implementation of things like CCU. For example, what is the legal status of CO2? Who owns CO2 which is in the air? Does anybody own it? What is the status? For many countries, it just doesn't have a status. It's a res nullius, as they say in Roman law. So it's just not a question. But at some point, it might become a question. What about the fiscal aspect? What about regulation of various CCU pathways and all these kind of things? So this is what I would call the relevant institutional framework. And of course, this also have a link with what Thierry just said about a good framework for the offset. And finally, I will end by just raising 2 points. In my view, one huge challenge we are confronted with, and really here I'm talking as a practitioner, working for many years for UNFCCC, UNEP, UNIDO, and like, is the incredible organizational complexity, bureaucratic complexity. You need years and years between the idea of a project which is accepted by GEF until the project starts, for example. More recently, that was early this year, some senior people said that, well, we should stop giving money to the Global Green Fund on climate because it will be just mismanaged and it's just like throwing money through the windows. So I think we have some serious challenge there. And it's clearly not the lack of funds, but it's really how it is managed and how it is processed. And another question I'm having is, okay, as some of the previous speakers said, the amounts we are talking are finally not that big compared to other previous revolutions. The question I'm asking myself is about the competition between all the funds which are needed for this transition and the competition with the funds which are going for technology dominance. And I'm referring here, of course, in the race for artificial intelligence or this kind of geostrategic technologies, which to some extent are probably perceived by many governments as having more priority than energy transition. Okay, I will stop here. Thank you.
Okay, thanks. So maybe on your last point, because it was referring to a point made by Han, who had to leave us for other commitments. There is this issue of what is the best allocation of funds. So we touch upon the role of digitalization, for instance, which is another technological advances, which might also be used in the context of energy transitions. But you refer to also short-term, for instance, research focused on health issues related, say, to the COVID crisis. So here, I think there are two issues with respect to the transition and in particular green finance. The first is perhaps, I don't know whether it's a lack of return or as you phrase it, perhaps Tim, this idea of having a long-term view about the return. So is there an issue about the return? And here I have in mind the following point, which is that in this energy transition, it is usually perceived as a negative supply shock to some extent. And what we are trying to do is to develop new technologies that will not necessarily bring new capacities, but simply replace, perhaps more costly, the one which we have to get rid of. So there is this one, and there is this another aspect that some of you mentioned, which is perhaps the lack of incentives. So where does come this? Where should this incentive come from? So is it a question of an adequate pricing of carbon? Is it something related to taxation? What would be your ranking with respect to these different issues? I don't know, Tim, for instance. From the market point of view, what would be the top priority?
Yeah, you need a price on
develop
carbon.
this aspect.
If you had a price on carbon, it'd make a huge difference. It's hard to have markets without a price, and so we have substitute prices and shadow prices, and we'll back into it via a cap and trade system. We did that with SO2 acid rain in the U.S. 20 years ago. You have huge compliance markets around the world. The Chinese are getting ready to launch probably the largest compliance market, carbon compliance market in the world. So we'll back into it, but we desperately need a price on carbon. It's politically sensitive, although there are ways to do it in order, you could do a tax and then redistribute the tax. But the problem with the U.S. is the right doesn't like it because they don't like taxes, and the left doesn't like it because of the distributional effect. So absent of that, we'll have to find other ways. And the key is how do you narrow the margin, the green premium over green forms of energy versus brown, which has externalities which aren't appropriately priced in. And raising and pricing in those externalities is politically difficult. So let's find ways to bring the green premium down, either through scale and deployment or through subsidization. And we do it in terms of electrical vehicles. We give a $7,000 tax credit to buy an electric vehicle. We can do it, as I said, through purchase agreements. We can do it through all forms of bribing and subsidizing. And we should do more of that until we're capable, until we're politically mature enough to actually price carbon. So it's inefficient, but it's a second best solution. And sometimes life is about second best solutions.
Mm-hmm. Could I add a corollary? Yes. Could I add a corollary to Tim's point? And I hope it doesn't sound academic to say so, but we need that price, but we also need prices, plural, because one of the challenges I think that we're facing with all these conflicts that come up between, say, a compliance market and a voluntary market is, in order to get to where we need to on, say, green hydrogen, that price, or we need to get to on direct air capture. These are prices of carbon that no one's going to accept today, and we can't go from markets which start at 10 and move to 120 overnight. That's just it's not only politically infeasible, it's economically infeasible to have that kind of price trajectory. So there is a real need to compartmentalize, and I think the work that Bob Litterman's done with trying to look at, in economic terms, you think about the shadow price of carbon, but they think about it as, you've got a totality of policies that are happening in an economy. And they've got a really nice, barometer that says you can stack those up and you go subsidies one way and you go, other forms of taxes and incentives and tax structures the other way. And you'll see there is a kind of a net price there. And the reason I mention this is just because there are going to be different solutions which will have different needs in terms of that incentive. And I think that it is just, unfortunately, and I don't think that this is Tim's shop that's saying this, but I think that there's been a very naive kind of sense that somehow a single global price around the world will ever manifest, and that if we just had it, it would sort itself out. And I think that the reality is, since we have compartmentalized and regionalized capital markets and technological activity, that the prices we should be accepting and anticipating that prices would manifest in both a lot of different ways, but at different price levels in different regions. And we don't need the investment banks to arbitrage that away for us. It's just simply not. I can understand why somebody would be tempted by that, but it's really not the way that we get the outcome that we're looking for.
Charlie, if I could just inject, I completely agree. I think the idea of a single price is more of a theoretical North Star. You're right; it is going to be fragmented. We see it in the natural gas market, right? We have prices around the world depending on location and shipping, and that's what we have. My one concern about being too highly fragmented is you end up getting excessive rent-seeking behavior. And not a lot of transparency. So there's a lot of, sweetheart deals that get done late at night in political capitals, favoring one technology over another. But I completely agree. We need to be pragmatic, realistic, start with what we have and try to work towards some idealized version, but that we may never really actually achieve.
Okay, I think that's that will be, unfortunately, the conclusion of this panel. So I think the last issue is very important because we are dealing with a global phenomenon. You are dealing with also global markets, but there is a need to have a price which is differentiated, and that also raised some issues about also some form of coordination in a way. so as to also promote the best practices with respect to these markets. So, but unfortunately, we will leave it for another discussion. So now we are going to end this session. And for the participants, I would like to inform them that if you want to attend the guest speeches, that you have to turn back to the BIS YouTube channel to follow on the conference. So with that, thanks a lot for your contribution to this panel, and I look forward to continuing the discussion later on and in the context of our different researches and focus. So thanks a lot for all of you, and goodbye.
Thank you, Laurent.
Thank you, Laurent.
Thank you.
Thank you.
Thank you, Laurent.
Thank you.
Bye-bye.
Bye.
Bye.